Are we looking at a falling knife, a glaring sell signal, or is this maybe one of the most wildly undervalued AI infrastructure plays on the market right now?
I mean, that is the multi-billion-dollar question. It's totally polarizing.
Right. Usually when you look at a stock chart, you get a sense of a narrative.
Yeah.
A company is either like steadily capturing market share or it's in this slow, recognizable decline.
Yeah, you can usually spot the trend pretty easily.
Exactly. But then you look at the subject of today's deep dive, and it looks less like a corporate trajectory and more like, I don't know, a seismograph during a major earthquake.
It is the absolute definition of a battleground stock.
Mhm.
The polarization we are seeing in the data is staggering. And honestly, both sides have these incredibly compelling, mathematically sound arguments.
So let's set the stakes here. The date is April 13, 2026. We are putting Applied Digital Corp ticker symbol, APLD, under the microscope.
And they're currently trading at what? Just over 27 bucks.
Yeah, 2714 to be
Wow.
exact. And the setup here is fascinating because they just reported earnings a few days ago, right on April 8th.
Right, and they actually beat expectations.
They did. They posted a non-GAAP profit of 9 cents per share. Now, conventionally, a beat is a beat. The market should celebrate.
You'd think so, yeah.
Instead, the stock is just whipping around violently. And our sources point to two massive anxieties keeping investors awake at night: an aggressive cash burn and a glaring lack of new, immediate lease announcements for their facilities.
Which tells you the market isn't really looking in the rearview mirror at last quarter's 9 cents.
Right, they're looking ahead.
Exactly. The market is staring at the fuel gauge. Investors are looking at the massive capital requirements of this industry and wondering how far the car can actually drive before the engine stalls completely.
Which is a terrifying thought if you're holding the stock. But hey, before we unpack the mechanics of that engine and dive into why this company is giving retail investors severe whiplash, do us a quick favor.
Make sure to like the video and subscribe to our YouTube channel.
Yes, please. And you absolutely must leave us some feedback in the comments. We really want to know where you land on this setup.
Definitely. And as always, just to establish our ground rules here, what we are doing today is unpacking the data and having a natural debate about the sources in front of us.
We are breaking down the financials, the charts, and the insider activity. But, this is strictly an exploration of information.
Exactly. This is not financial advice.
Right. So with that out of the way, let's get into it. You really can't understand the erratic price action of Applied Digital without opening up the company's books.
No, you can't, because when a company is operating in a hyper-growth sector like artificial intelligence, the fundamental analysis often just breaks down.
Let's look at the sheer scale of the swings here. We're talking about a company with a market cap of around $7.5 billion.
Which is massive.
It is. But check out this 52-week range. In a single calendar year, this stock has been beaten down to a low of $3.31 and then pumped all the way up to over $42.
Oh, wow. Yeah, that isn't just your standard market volatility. That is the market completely repricing the fundamental existence of the company, like multiple times over a 12-month period.
It's insane. And it reflects a really deep uncertainty about their runway. Because if you look at the income statement, their trailing 12-month revenue is sitting at roughly $319 million.
Okay, solid revenue.
But their net income over that same period, it's a brutal net loss of nearly $193 million.
Ouch. Yeah, and then you glance at the balance sheet and the plot really thickens.
Oh yeah, it does. They're carrying a total debt load of roughly $2.59 billion.
Nearly $2.6 billion in debt. That's heavy.
Very heavy. Now, the sources do note they're sitting on about $1.7 billion in cash on hand, but there's a major caveat there.
Right. Where did that cash come from?
Exactly. That cash pile was substantially boosted by recent debt issuance. So they essentially took out a massive loan just to pad the checking account.
Wow.
Okay, let's unpack this. It feels like they were flying a rocket ship, right? Just burning an incredibly expensive, highly leveraged fuel, just trying to escape gravity.
That's a great way to put it. And if we connect this to the bigger picture, to understand why a company would take on that kind of leverage, we have to look at the mechanisms of what Applied Digital actually does.
Right, they're building the infrastructure.
Exactly. They are an infrastructure company building these high-density data centers to power artificial intelligence.
And that's not cheap.
Not at all. You don't just buy a few servers and plug them into a standard commercial wall outlet. Building an AI data center requires massive upfront capital
Right,
expenditures.
you need power, lots of it.
You have to secure hundreds of megawatts of power grid access, which, by the way, is the single biggest bottleneck in the tech world right now.
Oh, absolutely. The grid is totally strained.
Yeah, so you have to physically build the facilities, install industrial-scale liquid cooling systems, and literally upgrade local power substations.
It's just massive physical world logistics.
Yes, and all of this heavy lifting happens years before a single hyperscaler signs a lease and plugs in a server to actually generate revenue.
I see. So the massive net loss and that $2.6 billion in debt aren't necessarily signs of a failing business.
No, not inherently.
They're essentially the unavoidable entry fees for an early-stage infrastructure play. Like, they are securing the land and the electricity before anyone else can.
Precisely. The debt is a feature, not a bug, of their current life cycle. But, that doesn't mitigate the danger.
Sure.
The market is constantly weighing the harsh reality of that massive debt load against the distant promise of future AI dominance.
And when fundamental financials are stretched that thin, logic often takes a backseat, right?
Oh, entirely. The stock chart itself becomes a battlefield driven purely by algorithmic trading and raw emotion.
Which is the perfect lens to examine the technical analysis and the order flow we are seeing right now. Because if you are trying to read the tea leaves on APLD, the chart is sending some incredibly conflicting signals.
It really is. Technically speaking, the sentiment is stuck in neutral.
Right. We are sitting above the 200-day simple moving average, which is bullish, but we are trapped below the 50-day simple moving average.
It is essentially locked in technical purgatory. And, for the listener, it's important to understand how those moving averages actually function in the modern market.
Yeah, break that down.
They aren't just invisible lines drawn by chart analysts. Algorithmic trading bots actually use those specific averages as trigger points.
Oh, interesting.
Yeah, so when a stock gets squeezed between the 50-day and the 200-day, automated buy and sell programs battle it out, creating the sideways chop until a catalyst forces a breakout in one direction.
And we are seeing that chop play out in real time. The stock recently broke out of a falling channel from early 2026, and now it is testing a rectangle formation.
Right, bouncing between support and resistance.
Exactly. The floor of that rectangle is around $20.49, and the ceiling is just under $44.
A pretty wide rectangle.
Huge.
Oh.
And even the momentum indicators are refusing to pick a side. The relative strength index, the RSI, is hovering right at 49.37. It is dead neutral.
Though our sources do point out that the MACD indicator recently flipped positive back on April 6th, which signals a potential upward reversal might be brewing.
But the real story for anyone trading this stock isn't really the moving averages, is it?
No, definitely not.
It is the sheer violent volatility. Applied Digital has a beta of 5.82.
That number is just wild.
Wait, I want to pause on that number because a beta nearing 6 is practically unheard of. For context, the broader S&P 500 has a beta of 1.
Right.
So practically speaking, if the overall market sneezes and drops 1% on a random Tuesday, this data implies APLD is algorithmically prone to plunging nearly 6%.
That is the reality of the mathematical leverage baked into the stock, and the options market absolutely confirms it.
Yeah, look at the implied volatility.
Exactly. The implied volatility looking out 30 days, the IV30 is sitting at roughly 107.93. Market makers are pricing in massive daily price swings of about $1.82 every single day.
Which brings us to this fascinating dynamic highlighted in our sources. There are significant liquidity zones, what the data calls trapped trader areas, right near the $25 and $26 psychological levels.
Yeah, retail trap zone.
Yeah. But wait, with daily swings of almost $2, how are retail traders getting systematically trapped at those specific round numbers?
Well, it comes down to human psychology clashing with institutional algorithms.
Okay, how so?
Retail investors love round numbers. When a stock falls from a high of 42, $25 feels like a clean, logical bargain.
It feels safe, like a solid floor.
Exactly, it feels safe. So thousands of retail traders set automated buy limit orders exactly at $25. The stock dips, those orders fill, and the retail trader thinks they caught the exact bottom.
Until the volatility kicks in.
Precisely.
Right.
Because with a daily expected move of almost $2, the stock doesn't just gently bounce off 25.
Right.
The institutional algorithms see all that retail liquidity, push the price right through it down to, say, $23, triggering everyone's stop losses.
Oh man, that's brutal.
Yeah, and then it violently bounces back up to 27, then drops to 24. The retail trader who bought at 25 is suddenly sweating, panicked by the chop, and makes a purely emotional decision.
Let me guess. The second this gets back to 25, I am selling just to break even.
You nailed it. Get me out of this ride.
So they unwittingly build a massive wall of sell orders exactly at those round numbers.
That is the trap. They are just desperate to get out whole. That cluster of break-even sell orders creates a self-fulfilling ceiling of resistance.
Wow.
Yeah, the stock gets bogged down in that $25 to $26 meat grinder until a massive piece of fundamental news comes along to finally blow past it.
That is fascinating. But while retail traders are getting chopped up, fighting over pennies in that zone, we need to look at what the smart money is doing.
You really do.
And this is where the sources present a glaring, almost uncomfortable contradiction. Let's look at Wall Street's consensus first.
Analysts are overwhelmingly bullish on this thing.
Extremely bullish.
Yeah.
We are looking at 12 to 16 different institutional analysts who currently rate APLD a strong buy or a moderate buy.
Which is a remarkably high consensus for a company burning through that much cash.
And the price targets are incredibly aggressive. The average target is around $39.20.
So that implies a 49% upside from where we are sitting right now.
Right, and the maximum target out there is $58. Wall Street is looking at this infrastructure play and screaming from the rooftops to buy.
Right.
But then we look at the insiders, the people who actually sit in the boardrooms and run the day-to-day operations.
The ones with the actual visibility.
Exactly. Over the last 24 months, insiders have sold a massive $31.6 million in stock.
That is a staggering figure that absolutely demands a closer look.
And just recently, on April 4th, insiders executed another $1.74 million in transactions.
Now, to be fair, the sources are careful to note that these recent sales were primarily for tax payments and share conversions.
Yeah, they do mention that. But still, the overarching narrative is jarring.
Oh, for sure.
So what does this all mean? Analysts are screaming that the stock is going up 50%, yet the C-suite has been offloading tens of millions of dollars. How do we reconcile that?
Well, by taking a very sober look at corporate mechanics, insider selling is not automatically a red flag, as much as people want it to be.
Why not?
Executives receive a massive portion of their compensation in stock. When those shares vest, the IRS comes knocking for the taxes. You cannot pay your income tax in APLD shares. You have to liquidate to generate actual cash.
That makes sense.
Furthermore, many executives use automated 10b5-1 trading plans, which systematically sell small portions of stock on predetermined dates.
Right, to avoid any accusations of insider trading based on unreleased news.
Exactly. So it could just be the normal gears of corporate compensation turning.
It could be.
However, and this is a big however, you cannot ignore the sheer volume. $31.6 million over 2 years is a massive outflow of capital from the people who have the deepest visibility into the company's timeline.
It really makes you wonder.
You have to apply some critical thinking here. Ask yourself if the internal projections truly support Wall Street's $58 price target. Why wouldn't you find other ways to finance your taxes?
Right.
Why take that many ships off the table if you know the winning hand is coming?
It completely begs the question of what they see that the analysts don't.
Yeah.
And that tension between Wall Street's optimism and the insider's pragmatism is the exact fracture line of the whole debate.
It perfectly sets the stage for the core debate surrounding APLD right now.
Is it a misunderstood generational bargain, or is it a highly dangerous value trap?
Let's put both cases on trial, starting with the bear argument, because it relies on some very sobering, cold mathematics.
Okay, lay it out.
The bears look straight past the AI hype and point right back to that cash burn. Applied Digital is currently running a negative 171% free cash flow margin.
Wow. Let's translate that into plain English because it is brutal.
Go for it.
A negative 171% free cash flow margin means that for every single dollar of revenue this company manages to bring in the door, they are burning through that dollar plus another $1.71 just to keep the lights on and build out their sites.
They're literally paying a massive premium just to exist right now.
And because of that aggressive burn rate, the sources highlight a very specific historical metric called the Altman Z-score. APLD currently has a score of 1.77.
Which is not where you want to be.
Wait, explain how that score works for us, because it sounds like a financial check engine light.
That is a perfect analogy. The Altman Z-score is a formula developed in the late 1960s. It doesn't just look at debt, it blends 5 different metrics.
Like what?
profitability, leverage, liquidity, solvency, and operational activity. It blends them all into a single number to predict the likelihood of a company going bankrupt within 2 years.
Oh, wow. So 1.77 is bad.
Very bad. A score below 1.8 places a company squarely in the distress zone. It is a massive red flag for institutional lenders.
So if macroeconomic conditions tighten, or if credit markets freeze up,
This company is at severe statistical risk of insolvency. If the music stops and they can't borrow more money to fund the construction, the whole house of cards collapses.
and the bears also point to the valuation.
Yeah. The price-to-sales ratio is sitting at an incredibly high multiple of nearly 32.9.
So investors are paying an absolute premium for future growth that might get completely derailed by bankruptcy before it ever materializes.
That is the terrifying reality of the bear case.
Here's where it gets really interesting, though. Because the bull case isn't just retail hype or wishful thinking on a message board.
No, it's backed by heavy institutional contracts.
Exactly. The bulls look at the macro environment. The industry is projecting the long-term AI infrastructure revenue market to exceed $16 billion.
The demand for compute power is utterly insatiable right now.
And Applied Digital isn't just hoping to get a slice of that pie. They already have ink on paper. They have secured massive 15-year lease agreements with CoreWeave.
CoreWeave is a huge player.
They are. And these aren't loose partnerships. These are binding long-term commercial leases projected to bring in over $11 billion in revenue over the life of the contracts.
What's fascinating here is the mechanics of that deal. CoreWeave is one of the most aggressive players in cloud computing for AI. By locking them into a 15-year lease, Applied Digital transitions from a speculative builder to a landlord collecting guaranteed recurring revenue.
That's a massive shift.
It is. They have an early mover advantage in high-density power. Like we talked about, the national electrical grid is practically maxed out. You can't just build a new data center anywhere.
Right.
Applied Digital has already secured the land, secured the power rights, and ordered the transformers. That creates a massive, almost impenetrable moat against new competitors.
So the bulls argue that a price-to-sales ratio of 33 today is basically irrelevant. Because if they successfully capture that $11 billion from CoreWeave over the next decade, today's $7 billion market cap will look like an absolute steal.
Right.
They are building the literal power grid for the AI revolution.
But again, it is a clean race between two conflicting realities. On one track, you have the operational revenue from these massive 15-year projections. On the other track, you have the ticking clock of their $2.6 billion debt and that distressed Altman Z-score.
It's a race against time.
Exactly. It doesn't matter how great your 15-year projections are if you run out of cash in year 2.
So if it really is a race against time, what are the actual milestones our listeners should be watching for right now?
Well,
Because if you are holding this stock or if you are sitting on the sidelines waiting for an entry point, you can't just stare at a 15-year horizon. You need to know what is happening next week.
right. The sources outline a very clear timeline. Let's start with the immediate short term, meaning the next few days.
Okay.
Technically, there is potential for a short-term reaction upwards driven by that positive RSI divergence we mentioned earlier, but the real catalyst is fundamental, and the market has its eyes fixed on a specific date, April 18th.
What makes April 18th the pressure valve?
Because the market is absolutely desperate for proof of concept. The recent earnings report caused all that volatility specifically because there were no new lease announcements.
Ah, okay.
The market expects potential news regarding their Delta Forge 1 site around April 18th.
So if the company drops a major PR announcement stating that Delta Forge 1 is fully leased out to a major hyperscaler,
The short-term narrative flips instantly. It proves their construction pipeline is actively translating into signed contracts, which immediately alleviates some of that bankruptcy fear.
so April 18th is the short-term binary event. But what about the medium to long-term horizon? How do they actually escape the distress zone of that Altman Z-score?
The company's entire survival thesis hinges on one specific financial target. They must achieve $1 billion in net operating income, or NOI, by fiscal year 2028.
$1 billion in NOI by 2028. That is only 2 years away.
Exactly. Over the next 24 months, as their new AI campuses finish construction, come fully online, and transition into operating data centers, they have to hit that $1 billion mark.
And if they do,
If they do, the narrative completely changes. That $2.6 billion debt load suddenly becomes totally manageable against $1 billion in operational income. They transition from a risky infrastructure play into a stable, cash-generating utility.
Wow. But what if they miss?
If they miss that target, or if construction gets bogged down in supply chain delays, that Altman Z-score is going to become a self-fulfilling prophecy.
It is wild how binary the outcome feels. They're either going to become the primary landlord of the AI boom, collecting rent from the biggest tech companies in the world,
Yep.
or they're going to become a textbook cautionary tale of expanding too fast with far too much leverage.
Which perfectly explains the chopped-up chart and the fractured analyst opinions we've been looking at. You have one camp looking at the 2028 NOI target and seeing $58 a share.
And another camp looking at the debt covenants, screaming caution.
Exactly.
We promised at the beginning we wouldn't give a definitive buy or sell answer, and honestly, the data is way too complex to reduce to a simple recommendation anyway.
It really is.
You have a stock that beats earnings but drops because of lease anxiety. You have Wall Street screaming buy while insiders sell tens of millions.
So such a contradiction.
Right. And you have $11 billion in future contracts sitting directly on top of $2.6 billion in current, very expensive debt.
It is the ultimate test of an investor's timeline and personal risk tolerance.
So we're going to leave you with a final provocative thought to mull over tonight.
Let's hear it.
During the original gold rush, the conventional wisdom was that you shouldn't buy the gold miners. You should buy the companies selling the picks and the shovels.
Right, the Levi's strategy.
Exactly. Well, in the artificial intelligence gold rush, Applied Digital is trying to sell the picks, the shovels, the land, and the electricity to run the whole operation.
The whole package.
But the question you have to ask yourself tonight is this. Are they building an impenetrable early mover monopoly that will quietly power the next decade of technology?
Oh.
Or are they simply digging a massive $2.5 billion debt hole they can never climb out of?
That is the multi-billion-dollar question the market is trying to answer right now.
It certainly is. Thank you so much for joining us on this deep dive into Applied Digital. Let us know where you land on that question down in the comments. We read every single one. Until next time, stay curious and happy researching.